My name's Lyn Alden of Lyn Alden Investment Strategy, and I'm here to talk about my outlook for 2021 and beyond, as well as how it can affect various asset classes, ranging from currencies to commodities to equities, and even into Bitcoin.
The dollar.
So since October of 2019, I've been in a dollar bearish camp, which is basically after we got the repo spike in September, I put out a public article explaining my longer term dollar bearish view. And so if you take a step back, if you look back over the past 50 years of the dollar index, ever since it became free floating in the 70s, we can see that there's been three really big dollar spikes and dollar declines. And most of those were based on either intentional movements or big shifts in monetary policy. And so we had the big giant spike in the mid 1980s. Then we had another big spike in the late 90s, early 2000s. And then we've had this third spike ever since quantitative easing ended in late 2014, early 2015. We've been in a strong dollar environment ever since. And so my base case, starting from that late 2019 period, when the dollar index was in the upper 90s, like around 99, was that we were likely beginning the third major decline. So we're probably ending this current period of dollar strength. And so we got a little curveball, obviously, in the early part of 2020 because we had the pandemic. And so we got that we temporarily had that spike, but then we had all the policy response that I was anticipating. And then since then, we've had a very sharp dollar decline. As of today, we broke below 90 in the dollar index. And so one of the big concerns now is if a trade goes your way, it becomes a crowded trade. And then the question is, do you stick with it, or is that trade over now? And so I think a really a part of answering that question has to do with making sure you establish your time frames. And so I don't have a strong view about the dollar over the next 3 to 6 months, because it is true that we've come down pretty far, pretty fast. It's a pretty consensus view that the dollar is going to weaken, and we have a variety of unknowns as we enter the new year. So we have what's going to happen with stimulus, what's going to happen with the vaccines, what's going to happen with rent, evictions, things like that. And so we still have this, as many people on Real Vision have pointed out, a solvency crisis, right? So we still have this broad solvency question. And so I don't have a strong view of the next 3 months or so. But as we look deep into 2021, I still have a pretty dollar bearish outlook, because if you look at how these dollar cycles normally end, they do tend to be pretty spectacular in their declines. So if you look at the monthly chart over the past 50 years, we're not even oversold yet on the monthly chart. I think until we kind of reach pretty sharp declines, that I still remain in a pretty dollar bearish long term camp. And I think a key level to watch is probably 88 on the dollar index, because that was the low over the past several years, right before we had quantitative tightening that pulled it back up. And so that's a potential support level. So I wouldn't be surprised to see a bounce or some sort of attempts. We also can look at the dollar compared to the euro. There are certain key levels there, but if we break below those, I think there's still room for more declines. If you look at the long-term dollar cycle, we can identify reasons for some of the shifts to happen. There's kind of this self-reinforcing mechanism, and so when the dollar gets very strong, a couple of things happen. One is you start to get a global slowdown, right? Because emerging markets with all their dollar-denominated debt, they start to have currency crises, recessions, sometimes depressions, and that of course trickles out into the developed world. And in addition, we start to see that because of that tightening, foreigners buy fewer treasuries, and so the
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
That of course trickles out into the developed world, and in addition, we start to see that because of that tightening, foreigners buy fewer treasuries, and so the treasury market has to become more domestically funded, and so we get tightening conditions, And so eventually what happens is we end up, corporate profits go flat in dollar terms during all these strong dollar periods. And we start to get a, declining GDP growth, some sort of tightening. And then usually it forces the Fed to become more dovish and supply more liquidity. And so when the Fed shifts to a more dovish policy at a stage where the dollar is mainly propped up due to offshore dollar shortage, due to tight monetary conditions, it has a lot of room to fall after then, especially because the United States runs persistent current account deficits, and then so its natural status is to want to fall, but it's held up by all this this offshore demand for it. And so when you get those big shifts in monetary policy, it does tend to fall pretty hard, pretty fast, because a lot of the conditions that were specifically holding it up are relieved and even reversed. So if you look at this current dollar cycle, the dollar strength began when quantitative easing ended in late 2014, and we've been in this strong dollar environment. And even the second leg of it, we started to get re-strengthening back in 2018. That was due to quantitative tightening. But ever since we had the Fed shift to balance sheet expansion in late 2019 in response to the repo crisis, we've been in this trend, of course, with the exception of the pandemic.
Views on growth, inflation, interest rates, and liquidity.
So as we get towards, especially the second half of 2021, a lot of the economic indicators look pretty favorable. And so, if the vaccines are successful, some people hope, if consumer, whether or not, however they function, if consumers just get more open, if governments stop doing lockdowns, we could potentially see, an increase in travel, increase in energy usage. That of course is coming after there have been a lot of capex cuts in the energy space, and so you're likely to see potentially higher commodity prices. And we've had so much broad money supply expansion that if you get past this current deflationary shock, it's also possible you see an uptick in inflation, potentially above the Fed's 2% long-term goal. And so, and if you look at how they've signaled in recent FOMC meetings, the Fed is not too strongly interested yet in directly controlling the long end of the Treasury curve. So they are buying a large amount of Treasury, so they're taking a lot of excess supply off the market. But they're still, and they have, of course, the lower end of the interest rates fixed at, roughly at zero. But they appear to be ready to let the long end of the curve, do its own thing, given that they're already, of course, taking a lot of that excess supply off the market. And so I wouldn't be surprised to see, rising long end of the curve next year, as well as an uptick in growth, especially later in the year. I think we still have to get past this challenging winter where we have this big unknown. So I think it depends on how you want to trade around that, or just establish a long-term position and being able to ride through volatility. The challenging part about estimating the next 3 to 6 months is that you're basically trying to assume how policymakers are going to respond. And so we're all watching to see what happens with congressional stimulus, for example. And so that's a pretty binary outcome. If you don't get the stimulus, then the solvency crisis becomes much more acute. If you get the stimulus, for many people that holds off the solvency crisis, because monetary policy can only address liquidity, whereas fiscal policy can potentially address solvency. Especially for the edge cases that are kind of borderline, and getting stimulus checks or getting some sort of aid can potentially get them through. And so we're looking at see how Congress is going to do with fiscal stimulus. We're also going to see if the Federal Reserve maintains liquidity conditions. So, for example, with so much Treasury issuance expected, while the Fed is, not really committing to higher, Treasury purchases or buying more into the long end of the curve, that could potentially actually squeeze liquidity, because, even though the Fed is buying a lot of Treasuries, they're not buying more Treasuries than are issued. And so it is important that they did signal that they're potentially willing to buy more Treasuries. So they changed their language in the latest FOMC, a statement press conference, to buying at least $120 billion a month of Treasuries and mortgage-backed securities combined. And so the Fed does seem aware of that liquidity issue. They certainly don't want any sort of crisis into year end, and so that they do seem to be on track to purchase as needed. But it's not necessarily going to be super liquid, because they're mainly just keeping up with Treasury issuance rather than front running that. One thing to focus on is, there's a lot of kind of temptation to chase some of the junkiest companies, right? Because if you get that rebounding growth, some of the most explosive gains can come from some of the weakest areas of the market. However, I like to emphasize quality here, even going into some of the more cyclical, some of the more challenging spaces. to find some of the best operators, the least leverage players in those spaces. And that's because, the fiscal authority can address solvency issues, but only up to a point. I mean, they're not going to bail everyone out. And so they're focused on making sure that the overall system remains solvent, that there's not some sort of deflationary collapse, that there's not some massive spike in civil unrest. And so they're addressing kind of the minimum needed to keep the system, stable in that sense. So, potentially, heightened consumer bailouts, some degree of small business or additional corporate aid. And so you see that around the edges, you see they take some of the blow off of the solvency crisis playing out, but it can't necessarily save the weakest firms, the most over leveraged firms, the one whose business models are structurally or permanently damaged. And so I'd be very cautious about chasing some of the weakest names, and definitely stick to solvent to the more solvent things that can definitely get past the next 6 to 12 months, that are structured in such a way that, if you're looking at energy, for example, ones that they can maintain solvency even at low energy prices. If you're looking at some of the more cyclical industrial companies, the ones that are least leveraged, best managed, because there's still, I think, potentially a good amount of value to get from those spaces. Another thing to keep in mind is that, we've had a pretty strong run in a lot of these value stocks over the past 6 weeks or so, or up to 8 weeks when this airs. And so it's important, to kind of separate the long term from the short term. So a lot of these names could be near term overbought, even though if you zoom out and look at the 5-year chart, the 10-year chart, many of them are still below where they were a couple years ago. So I still think that if you look out 3 to 5 years, some of these value names have pretty good room to run. But that doesn't mean they're necessarily going to run in a 6-month window, especially when they've already come pretty far pretty fast.
How Lyn's macro thesis shapes her investment outlook.
My overall portfolio positioning is still somewhat towards value, international equities, and commodities in general. And so I got pretty bullish on energy this summer when it was really washed out. But rather than buy, like, the absolute kind of bottom of the barrel shale companies, I've been emphasizing, low cost producers, strong balance sheets, high quality management that historically gets through the bear markets pretty well as some of the energy transporters that are, they're less commodity price sensitive. And so as long as there isn't a sharp reduction in production, they can do pretty well, and they can continue making profits on their fees and the volumes that they transmit. And so, same as, value stocks, for example, I've been cycling into some of the luxury makers, some of the industrials. And now the challenge, of course, is that in the past, 2 months or so, they have come pretty far, pretty fast. And so I think it's important to manage expectations about what they can do in any 6-month period. But, I think looking out over the next several years, uh, in this earlier part of a business cycle, after you get kind of this, this big economic shock, usually some of those more cyclical plays tend to do better. And especially if you compare them to tech stocks, many of them have been bid up to very high valuations because investors didn't know what else to invest in. Like, there's a broad solvency issue playing out, and so, long bonds and very long duration, high growth tech stocks were bid up to very high levels. Whereas I think some of that is likely to unwind, and there's much more interest in some of these, foreign equities, value equities, as well as in the commodity space. And so we've had a correction consolidation in gold and silver over the past, several months, and I think it's possible that that's ending. I still remain bullish on those with a 2021 outlook, especially on silver. In addition, I'm bullish on uranium, and of course, I've been pounding the table on Bitcoin this whole year. And even though we've had a pretty strong run there, I still remain quite bullish on Bitcoin with a 12-month view through 2021. If the dollar does continue to weaken, like, say, we'll test, we'll see what happens when the dollar index gets around 88, or how the dollar compares to some key levels in the euro. But if the dollar were to continue weaken, especially against emerging market currencies, that's historically pretty good for commodities for two reasons. One, of course, is that commodities are generally priced in dollars. So if you get a weaker dollar, that's beneficial for their dollar price. In addition, that weaker dollar tends to be good for emerging market growth, which is it's that's where most of the population is. That's where a lot of the commodity consumption is. That's where a lot of the global economic growth comes from. And so if you get that uptick in emerging market performance, later in 2021, that can be very beneficial for many types of commodities. And of course, they all have their own unique differences. So, for example, copper has done very well this year because there never really was a big supply glut for it in the first place. And so after the initial volatility it had, it's performed very well. In addition, you've had some supply reductions due to unrest at some of the mines or closures at mines. But of course, in the energy space, we've had a long period of oversupply, and so that's taking much longer to work out. In addition, we've seen some life out of uranium. The interesting thing about uranium, of course, is that it's on its own supply demand characteristics. It's not really tied to global growth. It's kind of operating on its own cycle. So it's a nice diversifier. And then, so as those forces play out, the combination of a weaker dollar and then the global growth that can come from that, it just tends to be historically a very strong period for commodities. And if you look at key charts like equities versus commodities ratio, that's bottom level. I mean, commodities have been terrible performers for the past several years, and so if you were to get that true rotation, commodities potentially have a lot of runway ahead of them compared to some of the high value tech stocks or some of the broad equity indices in general. And for Bitcoin in particular, I mean, Bitcoin, of course, it's kind of like uranium. It's on its own cycle. It's doing its own thing. It can still be impacted by liquidity shocks, other things like that. Like, pretty much every asset went down in March, for example. But for a multi-year view, Bitcoin tends to be very correlated to its 4-year supply halving cycle. And so my bullish case since April of this year is that Bitcoin is likely to do well through 2020 and likely to continue to do well through 2021, and could potentially get more overbought than people think. And so we've had a really strong, we're now as of this recording we're over 23,000, but of course it's volatile. So I mean that we could give up those gains, tomorrow, or we could go up another 50% in a week. Who knows? But I remain pretty bullish on Bitcoin through 2021 because it's accessible for consumers around the world. We're starting to see more institutional interest in it, both from hedge funds, even from some insurance companies, and so that I still think that's a very strong emerging asset class to consider, and that it's in some ways risky not to have at least some in a portfolio as a hedge.
How reflation will affect tech and value stocks.
So if you look at how the equity market generally behaves compared to the business cycle, 2020, of course, has been a very unusual year, and so we've had one of the worst economic shocks in history, while the S&P 500 reached new all-time highs this year. And however, if you separate out the big tech stocks and look at some of the more value sectors, they behaved generally like you'd expect in a recession. So of course, we had very bad performance in banks, energy stocks, industrials, things that are more cyclical, that are more tied to the actual real economy. Tech stocks have soared for a variety of reasons. One is rather than being harmed by the pandemic, they actually benefited from the pandemic in many cases. And even the ones that didn't benefit, they at least weren't harmed. Their cash flows were essentially intact. In addition, we had, of course, interest rates come down to historically low levels. And so whenever you have a company that most of their, if you look at their expected long-term cash flows, if a lot of that is out in the future at very high growth expectations, that is very sensitive to the discount rate you use or the interest rate that you're assuming. Whereas value stocks tend to have their cash flows more forward because they're trading at lower valuations, but they have lower growth. And so if we do get a rising rate environment, that tends to be harmful for some of those really kind of highly valued growth-oriented equities, and tends to be less harmful for value stocks, especially because they're tied to rising inflation expectations, rising growth levels, and of course banks in particular benefit from a steeper yield curve. And so if you were to get that dollar weakness, that uptick in interest rates, or at least just a leveling out of interest rates, that tends to be pretty good for more value-oriented stocks, as well as more international-oriented equities. Because I focus on individual equities, I'm able to separate out, stocks that I think are still attractive, even in a sector that I'm not particularly interested in. And so, despite the fact that I'm cautious about high growth or tech in general, I still think there are some areas that are better than others. And so, some of the more bubbly areas I've seen are in anything kind of renewable energy related, electrical vehicle related. Some of those stocks have gone absolutely parabolic, despite the fact that their fundamentals haven't really changed over the past 12 months. And so I think there's a lot of caution to be warranted in some of those sort of companies. In addition, IPOs are showing a lot of activity similar to the late 90s. replace the IPO with the SPAC. Look at the percentage of them that are profitable. Look at the price to sales ratios, things like that. We're seeing a lot of euphoria in the IPO market, and so I'd be very cautious about some of these no profit hyper growth stocks that are trading at extraordinarily high valuations. Now, if you look at some of the blue chip tech, for example, I think Facebook, of course, has all sorts of uncertainty around it regarding regulation. But if you look at it from a raw valuation perspective relative to consensus analyst forward growth expectations, that's an example that does not appear strongly overvalued. In addition, some of the Chinese growth stocks, for example, Tencent or JD, a lot of them are arguably fairly valued when you take into account their high expected growth rate combined with the fact that their valuations might be rich but they're not excessive. And so I still have allocations to certain tech stocks, certain growth stocks, but I've been trimming some of the more egregious high flyers from my portfolio over the past several months and emphasizing some of these more beaten down industries. For example, I sold Adobe and Nvidia earlier several months ago and put that somewhat into more energy exposure. And so I would like to see more correction because a lot of those companies are very high quality. It's just that if you buy them at the wrong price, it's not that hard to have a 3 to 5 year period of underperformance with them.
Views on emerging markets, real estate, and credit.
If you look back over the past several decades, usually whatever equity market does very well in one decade is generally not the same equity market that does very well in the next decade. And there are a variety of reasons for that. One is the big shifts in monetary policy, fiscal policy, mainly that we talked about with the dollar index and its big giant kind of multi-year rotations. But it's also due to valuations. So whenever a region is doing good for a variety of, whether it's demographics or fiscal policy, monetary policy, tech innovation, whatever the case may be, if an area is doing very good, capital piles into that until it brings it up to excesses. And if there's any sort of rotation in any of those factors that allow that market to outperform, then in addition to other markets doing well fundamentally, capital starts flowing to them. And so if you look back over the past 5 to 10 years, United States has been, the biggest performer, and we've hit historically high valuations. But if you look at many international markets, including emerging markets, their valuations are very historically reasonable. So if you look at, the previous emerging market peak was around that height, right before the global financial crisis around 2007 or so, and some of the valuations in China or India or Brazil were extraordinarily high. And we've had a multi-year, more than a decade-long consolidation, cooling off of valuations, and so many of those places are quite reasonable if you were to get that weaker dollar and that global growth outlook, because you're buying in at a pretty good base. Meanwhile, because the U.S. equities are so dominated by these very highly valued tech stocks, that if you were to get a capital rotation, those could potentially underperform, even if the underlying companies continue to do well. So, for example, I don't expect Amazon to do poorly, but I might think that its stock won't do as well as say some of its foreign counterparts, or compared to some of the markets that have not done very well over the past 5 to 10 years. Real estate's one of those places where there are specialists that cover it very closely. I monitor it from a pretty high, broad perspective, and I do think that if you look at the asset class as a whole, residential real estate is still reasonably attractive, especially in certain zip codes. Especially in some of the southern states that people are flocking to. Now, of course, it could be near term overbought, but again, if you're looking out over the multi-year perspective, if you can get an attractively priced piece of real estate with a very, very low fixed rate mortgage, while the Fed is doing their best to try to inflate, and we have fiscal spending, which is different than we've had over the past several years, that could be a pretty attractive piece of property. And so there's a lot of pressure on real estate in major cities. There's a lot of pressure on commercial real estate. That's certainly an environment where you need a specialist, because the overall commercial real estate industry is in a lot of trouble. But of course, there are some diamonds in the rough, so specialists can go in and find the properties that can be repurposed, the properties that they might have trouble, but they're priced so low that they're likely to do well anyway, especially if they get better financing. And so I think it's really important to when it comes to real estate, to focus on the specifics and make sure you know what you're getting into. So I still remain pretty favorable on it. In addition, if we do get continued, a strong housing data, that tends to further support a bullish commodity thesis, because home building is one of the more commodity intensive things in an economy. And so if you do get that in the United States and elsewhere, that just further adds fire to potentially a reflationary narrative or to a bullish commodity narrative. Again, especially when we're looking past, say, the next 6 months or so of big uncertainty. I'd be very cautious about some of the broad credit ETFs because as a whole, those yields are pretty low, and the market seems to still be pricing in that everything's going to be fine, even though the Fed is not really emotionally backstopping that market like they were earlier this year. And so I think there's a lot of risk in credit. Now, of course, there are specialists that can go in and separate the wheat from the chaff, but as an overall portfolio allocation, credit is still one of the areas that I'm quite concerned with, especially as you get this potential solvency issue playing out over the next 6 months or so. And so it's potentially useful as a portfolio hedge. You can, for example, be long many of these individual high quality things, and you can short credit. But there's a couple ways to play that. But credit is not one of the areas that I think has a favorable risk reward situation at this time.
Longer term views on the dollar.
When we talk about the dollar, one thing that's important to do is separate uh, a dollar bear for someone who thinks that the global reserve status is changing. And so a lot of times whenever we see a 5 to 10% weakness in the dollar, we often start to see headlines like, "Is the dollar losing global reserve status?" or kind of scare headlines like that. But it's funny because if you look back over the past 50 years, we've had these major dollar bear markets. But of course, the dollar never lost its global reserve status. In many ways, it strengthened it after some of those declines. And so it's important to keep in mind that there's a big difference between having an outlook for a weaker dollar versus having an outlook for some sort of structural difference. So the things we talked about before were mainly about dollar weakness within this current framework as structured. So it doesn't require any loss of global reserve status. It doesn't require any sort of major structural shift to the global monetary system. And it's mainly a result of the Fed becoming dovish and supplying liquidity, combined with the U.S.'s structural current account deficits, and that tends to be a weaker dollar environment. And so, but if we look forward over a longer term, we can also discuss some of those more structural issues that are starting to become pretty interesting. And so, if you look back over the past several decades, right? So if we look at the evolution of the global monetary system, prior to the global war, most currencies were gold backed. And then, of course, in 1944, we established the Bretton Woods system, which was that the dollar was backed by gold and other currencies were pegged to the dollar at fixed exchange rates. And there's a variety of reasons they did that. I mean, of course, the United States, emerged from World War II as a massive global superpower. We had something like 40% of global GDP. We had the largest gold reserves. We were also a custody. We were holding gold reserves for other countries. We were separated. We weren't damaged heavily from the war. And so it was basically that natural superpower status that allowed us to build that. Now, there were some economists from the beginning that warned that system would eventually break down. Keynes was a vocal critic of it, as well as Robert Triffin. And with Robert Triffin, he testified in Congress. It's now known as the Triffin dilemma. That basically that the system as currently structured back then would eventually break down. And there's a variety of different formations of the Triffin dilemma. His emphasis was mostly on the capital account at the time, and that basically that the United States would be forced to basically supply all these dollars, and eventually we wouldn't be able to back that situation. And so, if you look back over the next several decades in the 50s and 60s, we started to see that the United States' foreign liabilities began outpacing their gold reserves. We all think of 1971 as the moment where it broke down, but it was already gradually breaking down under the surface. It was already inherently unstable. And we started to get a sharp decline in U.S. gold reserves. And of course, in 1971, Nixon ended that gold standard by eliminating the convertibility of dollars into gold. And so that entered a new kind of era where all currencies were fiat currencies, and they were floating exchange rates. And then, of course, in the mid 1970s, we had that reformulated as the petrodollar system, which is that the United States made deals with Saudi Arabia and others, where some of these major oil producers would only sell their oil in dollars. So even if France buys their oil from Saudi Arabia, for example, they do so in dollars, even though it's neither of their currencies. And in exchange for that, the United States provides protection, keeps the global oil shipping lanes open, and basically provides that sort of order So they get the hegemonic benefits in exchange for having to supply a lot of military or geopolitical might around the world. And so this system's what we've been in for the past 4 to 5 decades. And there's starting to be some signs that it's working a lot less effectively than it did all those years ago. And so, for example, when we transitioned from the Bretton Woods system to the petrodollar system, the United States was still something like 35% of global GDP. But over time, as we've gotten the growth in emerging markets, which is where most of the population is, we've seen the United States fall to closer to 20% of global GDP, even though our currency is still being used around the world for oil purchases and commodity purchases and global financing. So it's much harder to use a currency of a smaller country for global needs than it is to use the currency of a bigger country. And so it's arguably the case the United States is no longer big enough to serve the role as being the only currency that all global energy can be priced in, for example. And that would be the case for any other currency block as well. I mean, the euro is not big enough. China is not big enough. There's no individual currency anymore that is large enough to supply the global world with the amount of currency needed to price all commodities and all energy in that currency. And so we're starting to see the emergence of payment systems that go around that dollar system. And so, of course, these were attempted decades ago by smaller countries, but because they lack political power, because they lack military power, they couldn't sustain that. Whereas now we're seeing players like Russia, India, China, places that are essentially immune from any sort of military intervention and somewhat resistant to sanctions. These countries have been pretty aggressive at establishing non-dollar payment systems, led, of course, by Russia. And so, if you look at the trade between Russia and China, it used to be almost entirely dollar-based, as recently as 5 years ago, but that's rapidly shifted more towards the euro and to some of their local currencies. In addition, if you look at trade between Russia and India, that is also rapidly de-dollarized. Even though India is still, for the most part, on friendly terms with the United States compared to Russia and China, they've still had an interest in kind of finding other payment channels. And then if you look, of course, at Russia and Europe, more and more of Russia's exports to Europe are priced in euros. And so now we're roughly at euro dollar parity between the trade that Russia's exports to Europe are priced in. And so as we see these systems gradually go around the system that's been in place for a while, it results in a more multipolar energy pricing world. And the reason that's important is because all these countries, it's all about a network effect. So all these countries, they have to buy commodities in dollars, so they have to maintain a lot of dollar reserves. A lot of global financing happens in dollars, and you get this big multi-decade network effect build up over time. But because it's performed so poorly over the past 10 years, especially since the global financial crisis, especially with the United States becoming no longer the biggest commodity importer, no longer a big share of global GDP compared to what it once was, we're seeing that inherent more decentralization. And so that's certainly something to watch as we move forward throughout the 2020s decade to see if that continues as it has been.
The health of the petrodollar system.
So there's a couple ways to monitor the health of the petrodollar system. And so one of the ways is basically to see if there's persistent global dollar shortages. And so this has been a topic that a lot of macro analysts have covered over the past decade. That we've been in a period of more frequent dollar shortages. And so if you look back historically, these dollar shortages happen during big spikes in the dollar, but they tend to be relieved more quickly. Whereas because we've had an increase in global debt, and because we've had a decrease in the United States' share of global GDP and global trade, that's put a lot of pressure on the circulation of dollars around the world and the availability of dollars to service debts or to buy commodities as needed. And so over time, the system's been fraying around the edges. And then, of course, you can separate different periods of time who's benefiting, who's being harmed by it. So the United States, earlier in the petrodollar system, was benefiting from it. It increased the United States' hegemonic power. But the sacrifice we had to make was, in order to supply the world with all these dollars to buy oil and all of this, we had to run persistent current account deficits. So we have a reformation of the Triffin dilemma, except instead of being focused on the capital account, it's focused on the current account. And so if you look at the United States' long-term trade deficit, current account deficit, it really collapsed starting in the mid 70s when we shifted away from the Bretton Woods system and towards the petrodollar system. And so basically, instead of drawing down our gold reserves piece by piece, we've drawn down our domestic manufacturing base and essentially shipped it to emerging markets. And of course, to some extent, all developed markets have done that. We've had more manufacturing from emerging markets. But for the United States has done it at a much faster and more thorough pace. So if you look at Japan, if you look at Germany, and many of these other developed markets, they still have a pretty robust domestic manufacturing scene, whereas the United States has outsourced it and has a much smaller share of its GDP derived from the industrial sector compared to many of our developed peers. And so we've had rising populism, rising economic troubles among blue collar workers here in the United States. And so it's already kind of breaking even within the United States. And then if we look globally, if we look at how different actors behave with this, so many countries have benefited from the system. And this is a chat I had back with Hugh Henry about some of these mercantilist nations that benefit from aggressively weakening their own currency versus the dollar, having persistent trade surpluses, building up big foreign exchange reserves, building up big manufacturing bases that they benefit from basically taking advantage of the fact that we have to run persistent trade deficits, and so there are countries like Switzerland, countries like Taiwan, countries like South Korea, countries like China. A lot of these have benefited from the system as currently structured. But that eventually reaches a tipping point where if they want to be, for example, free of U.S. sanctions. So China has benefited from the system and they've grown into a very, very large nation. But now that they're a larger commodity importer than the United States, they find it less in their favor to be relying on a literally a smaller a country with less commodity imports, their currency to buy all of their commodities with. And so they're more interested in now shifting from that more export-driven economy to a more balanced economy or a more consumption-driven economy. And in doing so, being able to buy commodities in more than one currency, including potentially their own currency, is something they have an incentive for. In addition, they don't want the vulnerability of being exposed to U.S. sanctions or basically having their payment networks shut off by a foreign country, just because if they all have to pay if all of their payments route through New York, that's outside of their control, and so they have an interest in shifting more towards these digital currencies and domestic payment networks, or at least diversifying their payment networks. Going through Europe, going directly with Russia, all these different technologies and different kind of platforms that they can use. So that's something to keep in mind is that as we go forward, some of these more powerful nations, even ones that historically benefit from the system, no longer see it in their interest to keep doing the system the same way. And of course, Russia, United States and Russia have had a long antagonist relationship, and we're seeing more interest out of Russia over the past several years to, in response to U.S. sanctions, to basically de-dollarize and to, price their oil in euros or other currencies wherever possible. And then lastly, we've had China in some ways subverting the petrodollar system by intentionally making a lot of dollar-based loans. And so, up till about 2013, China focused on being this aggressive exporter, building more and more treasuries in their reserves, buying treasuries, and then they decided it's no longer in their interest to keep buying treasuries. They publicly stated it's no longer in their interest to keep accumulating, and then instead they announced the Belt and Road Initiative, which is basically that they want to promote infrastructure projects throughout the world, especially Eurasia, all throughout developing markets, even into Latin America, Eastern Europe, Asia Pacific, and so they started making instead a lot of dollar-based loans to these developing markets, in addition to providing their infrastructure expertise, because China has a long history of these big mega projects, and so they can provide both financing and technical expertise. And of course, that creates a problem for the United States because historically, our end of the bargain is we have to run these big current account deficits, but then all those dollars we send out to the rest of the world, they mostly get reinvested in treasuries and held in reserves. But then if those countries keep running those trade deficits with us, but then no longer even buying our treasuries, and instead they're financing their own commodity needs, their own infrastructure needs, that really kind of gets around the hegemonic benefits the United States had from the system for several decades. And so we're starting to see that the current system as structured is no longer really benefiting almost anyone. It's not benefiting the United States, and it's not benefiting some of these other countries, except for ones that are still being highly mercantilist or that are subverting it. And so that's why I think over time, we're likely to see a more diversified global energy pricing model.
Technical analysis of foreign ownership of treasuries and other dollar-denominated assets.
So if you look at the long-term dollar cycle, it is pretty normal that in the later stages of a dollar bull run, we start to see declining foreign purchases of treasuries. And there's a variety of reasons for that. A big reason is that they simply can't, right? So when the whole world becomes tightened by dollar tightening compared to the dollar-based debts, we start to see instead of buying treasuries, we start to see either them selling some of their assets to defend their currency, or we at least see a slowdown in purchases. And so that this happened in the mid 1980s. It happened again starting in the late 90s, and it happened again, over the past 5 to 6 years. Whenever you have this really strong dollar environment, it puts enough pressure on them, and then the United States end up having to self finance more of its fiscal deficits. Now, this latest period is somewhat different because it actually started to happen a little bit before the dollar strengthened, and it began happening a year or two earlier when China announced that it's no longer in their national interest to keep accumulating treasuries. And so there's a variety of reasons for that, but basically you have the combination of strategic reasons for no longer buying treasuries, as well as the natural tightening effects of the strong dollar kind of preventing a lot of treasury accumulation. And so in China's case, this is the first time where an emerging market became so big that it was, it's able to act, more freely in the global marketplace and start acting in some ways like a developed market when it comes to international financing. So an emerging market that finances other emerging markets. And so China's, it doesn't fit neatly in the emerging market or developing market basket anymore. Of course, if you look at per capita GDP, they're still firmly in the emerging market camp. But if you look at the overall geopolitical power that they wield, as well as some of the technical capabilities they have, some of the infrastructure capabilities they have, in some of those ways, they're more in line with the developed market. And so it's a very kind of a unique situation compared to the previous $2 cycle peaks. And so, if you look at, just the math of how the globe is structured, there is a lot of dollar-based debt out in the world. It's something like 13 trillion based on the BIS estimate. It's probably more than that when you count other forms of leverage. But in addition, the whole world as a collective has something like 40 trillion in U.S. assets, and that includes treasuries, that includes U.S. stocks, that includes corporate bonds, that includes U.S. real estate, and of course, one of the challenges is there's not a perfect overlap. And so some of the countries have a ton of assets, whereas other countries, some of the ones that have a lot of liabilities, don't have a lot of assets. And those are the ones where we see currency crises. So, for example, Argentina, Turkey, places like that, they've had a lot of dollar-based debts, but they haven't really had the massive foreign exchange reserves or other strong sources of U.S. assets, sovereign wealth funds, to be able to offset that. Whereas if you look at Europe, if you look at Japan, if you look at some of the stronger developed markets like most of Asia, they tend to have a lot more dollar-based assets than they have dollar-based debts. And that's in some ways what forces the Fed to shift to a dovish monetary policy. So when we got that dollar spike earlier this year, for example, during the heart of the pandemic, we started to see foreigners sell some of their treasuries to satisfy their dollar-based needs. And when you have foreigners selling treasuries, and then you have risk parity funds selling treasuries at a time when you want to issue a record amount of treasuries, that's of course a problem. And you can't have the treasury market become illiquid, which is what we saw. And so the Federal Reserve had to step in and create bank reserves and buy $1 trillion worth of treasuries in a 3-week period. And so that kind of that's one of those big shifts that you see at the end of a dollar bull spike. Of course, this one was in some ways more extreme. And so that's why if you look at the longer term, as the system's currently structured, I think that even if we get a dollar weakness period, we could start to see more forward treasury accumulation again. But I doubt that we're going to hit the peak. If you measure it as percent of U.S. treasuries owned by foreigners, I doubt that we're going to hit the peak that we hit back in 2013 or so.
FX reserves, debt levels, and Paul Volcker.
So when we separate out what happens over the course of a normal dollar cycle with what could happen over the next cycle, there's a couple of things to keep in mind. So as I pointed out, whenever you have this dollar strengthening period, you have fewer foreigners buying treasuries. And so we see the share of total treasuries owned by the foreign sector goes down. Now, whenever that dollar situation gets relieved, we get a weaker dollar. Then we get a rebound in foreign purchase of treasuries. We get more global growth, and so that they're able to get more dollars and buy more treasuries. And we over the past couple cycles, we've hit new highs in terms of foreign ownership of U.S. treasuries. Now, my base case is that the ultimate peak was probably in 2013, and that due to the fact that China's it's more strategic now. So instead of just the dollar strong period, it's also that we've essentially run out of major economies willing to accumulate a lot of treasuries, because I think we're getting closer to the end of the system and structure over the past 50 years. And so there are a couple ways to measure what might have been the peak in the petrodollar system. So one way to look at it is that if you look at the allocation of foreign exchange reserves, the dollar hit treasuries and the dollar hit the peak in the early 2000s. So with the introduction of the euro, the United States was at over 60% of global foreign exchange reserves. But then as we've had some competition from the euro, we've seen that the United States over the past 20 years has slightly declined from that high watermark. Now, the United States is still the Treasury is still the most dominant currency by far in global exchange reserves, but it's never retained that high peak that it reached in the early 2000s. So you can argue that might have been the peak of the system. Another way of measuring it is you can look at U.S. Treasuries and then look at the percent of them owned by the foreign sector. And so that peaked somewhere around 2013. So you can also argue that that might have been the peak of the system, and that if we never reach that level again, that the system is now kind of winding down rather than continue to build up cycle by cycle. And so that's kind of how I'm viewing it. It is that in some ways you can argue that the early 2000s were the peak, and I guess another way to measure it is that 2013 was the peak, which is probably the peak I would go with. That's where a lot of things changed structurally. Now, if you look at this isn't the first time where the system was in danger. So if you look back in the 1970s, of course, when the system was still in its infancy and the United States had very high inflation in the late 70s, the system, started to break down pretty early on in its life, right? So we could have had an alternative world where after Bretton Woods, the United States was never able to reassemble the global reserve currency. But of course, in this timeline, the United States did reassemble it, in part due to Volcker. And so we started to get the dollar share of global reserves was going down. Gold was going up, of course, because the dollar was devaluing versus gold. And then, of course, when Volcker jacked up interest rates, that gave a lot of global credibility to the dollar and basically said, no, this dollar is here to stay. It's not going anywhere. It's not going to lose a lot of value. And then we entered a 40-year period of, basically, if you own treasuries, you got a positive real return on those treasuries, right? So instead of inflation eating away at your treasuries faster than your interest rate, Volcker brought us into a 4-decade period of subdued inflation, positive real yields, and it made that treasury a very attractive asset to hold around the world. Now, if you look at recent times, that's no longer the case. So the treasuries are no longer keeping up with inflation, and we're issuing so many treasuries that the Federal Reserve is now the biggest holder of treasuries. And so we're eating our own cooking in a way. It's like if we were running a restaurant, but then eating most of what we're making rather than our customers eating it. And so if you look at a chart, for example, the Federal Reserve now owns more treasuries than all foreign central banks combined, which is structurally different than how it worked over the past 20, 30, 40 years. And so we're kind of entering a new era of self-financing and just less of a buildup of foreigners owning more and more treasuries as a percentage of our total treasuries. And you could think, like, could that happen again? Could we somehow save the system, prevent this gradual unwind? But the answer is probably not, because the environment that Paul Volcker had to work with was a very low debt environment. And so the United States, we reached peak debt levels back in the 1930s, 1940s, and then we entered a multi-decade period of lower and lower debt as a percentage of GDP. And in the 70s, that hit a system bottom. And so Volcker was able to raise rates to double digits, pretty much whatever number he needed to quell inflation, because debt levels were so low. It wouldn't result in a broad solvency crisis for him to jack up interest rates. But because we've been in this environment of declining interest rates now for 40 years, we have so much debt built up in the system, so much federal debt, so much private debt, that if you were to jack up interest rates and keep them at a positive real yield for a long period of time, the system would likely become insolvent as currently structured. And so we're entering this phase where the United States, in their own interest, has to keep real yields negative in order to continue to finance themselves and keep debt from growing rapidly compared to GDP. But that also prevents us from making the Treasury a very attractive asset for a lot of foreign central banks to still want to own.
The long-term outlook, global Bancor, decentralized energy pricing, and central bank digital currencies.
So if you look at the very long term, right? So we already have kind of maybe an outlook for what's going to happen in the next couple of years. But if you look at, if we're trying to envision what the next 10 years looks like, for example, we can kind of start to look at a range of possibilities for what the next global monetary system could look like. And so my base case is essentially a gradual fraying of the current system. So with a lack of kind of central leadership, we start to inherently see more and more decentralization. So I already talked about, Russia is seeking to price its exports, and so far successfully over the past couple of years, pricing its exports in euros, in rubles, in other currencies, essentially. And so my base case is to see that continue. So I think that China can continue to diversify the currencies it uses to buy commodities. I think Russia is likely going to be successful in continuing to sell oil in euros or other currencies. And so uh, I think that over time, we can see the dollar gradually decrease as a percentage of energy trade worldwide. So it's had historically had an almost 100% lock, and that could go down over time. Now, it still might be the largest individual currency involved in global energy pricing, but it'll no longer be that near 100% monopoly. And so that's my base case going forward, is to see a diversification in payment channels. And so the European Union has Instex, for example. We haven't seen a lot of activity out of that, but it's something to keep watching. We've seen, emergence of central bank digital currencies, and we're seeing that roughly happen in order of establishment systems. So the Fed has been slow to act in terms of digital currencies because we're the ones that run the current system. The United States is at the heart of the current system, so we have less of an incentive to disrupt ourselves and move forward. Whereas China, that is less thrilled with the way the current system is structured, because they want more self-sovereignty with regards to their currency, their commodity pricing. They've been more aggressive at advancing their currency. And so with China spearheading the central bank digital currency, that could potentially expand their usage of alternate payment systems that don't use SWIFT, that don't go through New York, that aren't dollar based. And so that can include domestic usage, but of course also with their trade partners like Russia, with Asia Pacific. We of course have that really big new trade deal for most of the Asia Pacific countries. And so I would expect to see more and more non-dollar pricing over time. Now, there also are certain kind of abrupt scenarios that could happen that accelerate that. Like if the United States no longer tries to maintain the current system, they could do something like a sharp dollar devaluation. They could do there are a variety of factors they can do to have a more stepwise increase in the usage of non-dollar payment systems around the world. But as a base case, so I maintain that as a possible kind of tail risk upside to that scenario. But as a base case, I look for a gradual decentralization of how global payment networks work, both due to existing technology, just a strong incentive, for some of these countries to want to go down around the dollar-based systems, as well as the new technologies from central bank digital currencies or private stable coins that allow, more ways to bypass the current system. And then if you look at, for example, even Bitcoin is becoming interesting because we see some of these more rogue states explore its use as a way to bypass sanctions. So we see, for example, Iran, dabbling in Bitcoin potentially as a way to go around any sort of sanctions, because Bitcoin is, of course, decentralized. Transactions can't be stopped between willing parties. And so as all these different countries try to build their own system, we're also seeing, just from the shadows, Bitcoin has emerged from zero to a $400 billion market cap asset class, and that potentially can also serve as a form of global payment. We could start to see it show up on some of these smaller central banks that are not at the heart of the current system. If we go back and look at the formation of the Bretton Woods system, so of course I mentioned that it's the dollar's pegged to gold and other currencies are pegged to the dollar. The competing idea at the time was something called a Bancor, and so that was proposed by Keynes. And there are a couple of different versions that it could take, but essentially the Bancor would be a basket of multiple major currencies that central banks could use as a medium of international trade and as a reserve holding. And that would basically make it so that the global reserve currency wasn't any one country's currency, but instead it was this neutral actor. But of course, that lost out to Bretton Woods. Now, it showed up in the late 60s in the form of the IMF's special drawing rights. And so they issued these baskets of multiple currencies that several central banks still hold to this day. Some current countries pegged their currency to the SDR, and so that was essentially a global money. It was a global monetary unit that could be used to settle trade or held as reserves. But it never took off. It never became a big player in the global scene. Now, in recent years, the emergence of stable coins have reintroduced that possibility. And so, for example, we saw Facebook kind of attempt to come out with the Libra, and so that's still a shifting project over time. But that would have been essentially a private Bancor. That would have been a basket of global currencies in a stable coin wrapper. But instead of introduced by the IMF, it would have been introduced by a private company. And we've also seen, for example, some kind of key policymakers like Mark Carney, for example. He referenced the Libra and has basically been a proponent of something like a Bancor that's kind of used in the modern technological sense to reduce the focus on the dollar and to have a global unit that is backed by multiple currencies as a basket. Now, the problem with that system is it requires a lot of international cooperation. So as we see, the world become more and more bipolar between the United States' sphere of influence and China's sphere of influence and Europe's sphere of influence, that something like a global cooperation seems rather unlikely. It's not impossible, but it requires a lot of pieces to fall in line to have something like a global Bancor be used. So there are a couple other possibilities. We could see regional Bancors, for example. We could see certain trade partnerships agree to use some, a stablecoin unit that might consist of a basket of multiple of their currencies. And so there are a couple of things to watch in that regard. We could also just see none of that and just see continued decentralization of payment networks as they're currently acting. So we could see, for example, Europe able to buy more of its energy in euros. We could see China able to buy more of its energy in either euros or its own currency. We could see, of course, the United States will continue to buy energy in dollars, and many other countries will. And so we could see, multiple major currencies that all act as regional global reserve currencies rather than one central global reserve currency. And of course, as those currencies become increasingly digital, that eases their ability to be used as international trade and go around heavily centralized payment systems.
Gold as a reserve asset and the Bitcoin standard.
Some of the proposals for how global trade could be restructured involve gold. And so, part of why, part of why we've had so much issue over the past 5 decades is that with this environment of floating exchange rates, it really incentivizes mercantilist behavior. It incentivizes countries to basically weaken their currency to make sure that their exports are strong and develop trade surpluses. And so we've been in this environment of competitive currency devaluation, and that'll likely continue to some time. But especially if you enter a more inflationary phase, or if that whole situation becomes unsustainable, there could be calls to try to fix currencies to something to prevent that. And so, of course, one of the topics that comes up is, of course, gold, because that was historically the major peg for many currencies. Now, the problem with gold is that at the current prices, it's nowhere near big enough to back a global currency in any sort of significant way. And that's, of course, why you've seen calls for some analysts for much, much higher gold prices, because gold would have to grow as an asset class if it were to ever back those currencies to a meaningful degree again. Now, of course, you could see limited gold usage. For example, over the past 5 years, we've seen a renewed accumulation in gold by central banks. So even if gold is not officially backing any currency, it can be a reserve asset. It can be an implicit kind of backstop to the currency. We've seen that especially out of Russia. They've been very aggressive at buying gold, but a number of other countries as well that they've been using gold as one of their foreign exchange reserve assets because it's neutral, because it's somewhat inflation adjusted. It's not backed to any one country's currency. Now, we're also seeing, of course, Bitcoin emerge. Some people have been proponents that Bitcoin could take gold's mantle as a global reserve asset. And of course, the problem is that right now, Bitcoin's quite small in the grand scheme of things. So gold is estimated to be something like a $10 trillion asset. If you look at the global market cap of estimated gold, according to the World Gold Council or other entities like that. Now, Bitcoin is a fraction of that. As of this discussion, Bitcoin is worth something like $400 billion, and it's much more it's a much higher volatility. And so we know we're not seeing Russia, for example, rush in and say we're going on the Bitcoin standard or anything like that. We're only seeing it show up in some of these more rogue nations potentially. But if you were to get a case, 3 years from now, 5 years from now, where Bitcoin continues to grow in market capitalization, it becomes a multi-trillion-dollar asset, and if the volatility goes down over time due to more widespread ownership and due to more liquidity, then you could see Bitcoin become interesting as a reserve asset because it's both a store of value and a payment network combined into one. And so it solves one of the problems of international trade, which is trust and currency pairs and things like that. Whereas if you use Bitcoin as a settlement asset or as a reserve asset, it's basically it's neutral. It's not tied to any one currency. There's nothing they can sanction you from using it. There's no one that can turn off your Bitcoin or block you from doing transactions. And so in a world with less centralization and more distrust and more actors wanting to be able to do their own thing, incorporating Bitcoin is one of the ways that they can go around that. Now, it's still, I think, premature to discuss that too much because again, Bitcoin is still a very small asset. I'm mostly emphasizing Bitcoin as there's a couple ways to look at it, but essentially digital gold as a store of value that is backed by the network effect of Bitcoin, that is backed by the scarcity of its supply. But if it were to continue to do well in that particular sense, then it opens up questions. What could be next? Could we see it show up on more central bank balance sheets, or will it ultimately be limited to just a store of value for private actors? So if we look at over the next 6 months, there's a lot of uncertainty. A lot of these kind of value or commodity-oriented things have come very far, very fast. We've had a pretty rapid decline in the dollar in recent months. And so the next several months are vulnerable to corrections, vulnerable to counter rallies, vulnerable to all the political uncertainty that's happening with stimulus, with monetary policy, with the vaccines, with the winter. But as we look out over late 2021, as we look out into 2022, I think the odds are more towards global reflation, continued weakening dollar within the grand scheme of this kind of 50-year floating exchange rate dollar. So the third kind of major bear leg in the dollar, which if that happens would be quite beneficial for commodities, quite beneficial for emerging markets. Also, of course, things like uncorrelated assets like uranium or Bitcoin are pretty attractive in this environment, as well as just international equities more broadly, U.S. value stocks, especially if you have some sort of quality filter to emphasize ones that are, they might be in troubled industries, but they're one of the stronger ones in their industry. And so that's essentially how I'm playing it, is to have that kind of global reflationary outlook, but be in quality names so that you can survive a 3 to 6 month counter rally. It's not like a heavily leveraged kind of outlook, and it's rather a more resilient outlook towards that period of decentralization and reflation.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. However, this is just the tip of the iceberg. For more in-depth content and expert analysis, visit the membership link in the description to unlock a week's access for only $1. This dollar can change your life.